$1 trillion. That is the silent number now haunting Wall Street, not because of a war, not because of a pandemic, but because Canada just pulled the plug. This week, Canada's largest banks, institutions that quietly bankroll America's real economy, began tightening credit and withdrawing billions of dollars from U.S. commercial real estate and small business lending. No press conference, no drama, just capital quietly leaving the building. And here is the brutal truth Washington does not want to admit. This crisis is self-inflicted. Donald Trump's latest threat to impose punitive taxes on cross-border profits of foreign financial institutions was meant to project strength. Instead, it triggered something far more dangerous, a loss of trust. Canada didn't protest. Canada didn't retaliate with speeches. Canada did what rational actors always do in an economic war. It de-risked. So now ask the question Americans are about to feel in their mortgages, their business loans, and their pensions. Why would the United States deliberately attack the legal foundation of foreign capital while Canada is calmly repositioning itself to win? This is not a trade dispute. This is a financial betrayal, and the collapse has only just begun. To understand why this moment is so dangerous, you have to understand a fact most Americans never see on cable news. Canadian banks are not foreign extras in the U.S. system. They are load-bearing pillars. Canadian institutions provide an estimated 20 to 25% of cross-border commercial real estate financing in key U.S. metropolitan markets. In states like New York, Florida, Massachusetts, and Illinois, Canadian banks are among the top lenders to mid-sized developers, logistics hubs, office parks, and, most critically, small and medium-sized enterprises that cannot access cheap capital from Wall Street giants. This matters because the U.S. financial system is built on just-in-time liquidity. Businesses do not stockpile cash. Real estate developers roll over short-term debt every 6 to 18 months. Regional banks depend on syndicated lending partners. Remove one pillar and the entire structure begins to creak. Now layer Trump's threat on top of this reality. A tax on cross-border profits is not a symbolic gesture. It is a direct attack on risk-adjusted returns. Capital is mathematical. If legal predictability collapses, required returns spike. When returns spike, lending stops. When lending stops, projects freeze. And this is where Washington's miscalculation becomes fatal. Canadian banks operate under some of the tightest capital adequacy rules in the G7. They are structurally conservative. When risk rises, even politically manufactured risk, the response is automatic. Tighten credit, pull exposure, redeploy capital elsewhere. There is no emotion here, only math. Commercial real estate in the U.S. is already under stress. Office vacancy rates above 18% nationally. Refinancing cliffs approaching hundreds of billions in 2026, 2027. Regional banks already weakened by unrealized losses. Into this fragile system, Trump injected legal uncertainty. So when Canadian banks turn off the tap, it is not theoretical. It means construction halted mid-project. It means small manufacturers denied credit lines. It means landlords unable to refinance balloon payments. This is how financial crises actually start, not with explosions, but with liquidity quietly evaporating. And the most dangerous part? Washington still thinks this is leverage. In reality, it just pushed the system closer to collapse. This is where Trump's aggression turns inward and starts eating the American economy from the inside. Because when Canadian banks pull back, Wall Street does not feel the pain first. Main Street does. In New York, Canadian lenders are deeply embedded in commercial real estate refinancing. Office towers, mixed-use developments, and logistics warehouses tied to port activity. As credit tightens, refinancing windows slam shut. Projects that were viable at 4 to 5% interest suddenly face double-digit rates or no offers at all. Developers freeze, layoffs follow.
In Florida, the damage is even more immediate. Canadian banks are major financiers of residential and mixed-use developments tied to migration and tourism. When those banks retreat, liquidity dries up in cities like Miami, Tampa, and Orlando. Property values wobble, insurance costs spike. Local banks, already overstretched, cannot absorb the shock. In Maine and the Northeast, small manufacturers and exporters feel it next. Canadian banks are often the quiet partners behind cross-border trade finance. When those credit lines tighten, shipments slow, payrolls get delayed, expansion plans die. And this is not speculation. A senior executive at a regional banking association put it bluntly in private briefings. This is 2008 behavior, but without a housing bubble. It's a policy-induced credit seizure. Here is the irony Washington refuses to face. Trump claims to be protecting American industry, yet his policy is starving it of oxygen. Small businesses do not issue bonds. They do not tap equity markets. They survive on revolving credit, bridge loans, and refinancing cycles, many of which are underwritten or syndicated by Canadian institutions. When Trump threatens those institutions, they do not negotiate, they exit. And Wall Street knows it. Liquidity indicators are already flashing red. Spreads widen, risk premiums climb, banks hoard cash, credit committees become hostile. Deals that would have closed 6 months ago are now under review. This is how confidence collapses, not in headlines, but in spreadsheets. Trump wanted to punish foreign banks. Instead, he triggered a cascading retreat of capital that is now punishing American workers, American borrowers, and American cities. And the most dangerous phase is still ahead, because capital, once gone, is not easily replaced. While Washington is still arguing on television, Canada has already moved on. This is the part American policymakers consistently underestimate. Canada does not respond to economic aggression with noise. It responds with reallocation. The moment Trump threatened cross-border financial profits, Ottawa treated it as a signal, not a bluff. The signal was clear. The United States is no longer a legally predictable destination for foreign capital. And capital, above all else, hates unpredictability. So Canada began executing its contingency playbook. Canadian banks are now redirecting billions in deployable capital away from U.S. commercial real estate and into jurisdictions where rule of law is boring, stable, and respected. London, Singapore, Frankfurt. Quiet announcements, quiet exits, no drama. Mark Carney summarized the doctrine with surgical clarity. Capital flows to where contracts are honored, and Canada is acting accordingly. At the same time, Ottawa is accelerating financial decoupling infrastructure. Cross-border exposure is being replaced with deeper integration into European and Asian capital markets. Canadian pension funds, already among the largest pools of patient capital on Earth, are following the same path, increasing allocations outside the U.S. dollar ecosystem. This is not retaliation. This is insulation. Meanwhile, Canada is strengthening its partnerships with Mexico and the European Union, aligning financial standards, trade settlement mechanisms, and regulatory cooperation. The goal is obvious: reduce reliance on a partner that has become politically volatile. And here is the part Washington truly does not understand. Canada does not need the United States the way it once did. Energy exports are diversified, critical minerals are in global demand, financial services are mobile, capital is agile. The idea that Canada must tolerate legal threats to keep access to America is outdated thinking from a bygone era. In reality, Trump's aggression accelerated a transition that was already underway. The U.S. believed it was squeezing Canada. Instead, it handed Canada the justification to detach gracefully, while leaving American borrowers trapped inside a shrinking credit pool. This is not a temporary maneuver. It is a structural shift.
And once capital builds new habits, it does not return out of nostalgia. This is where the damage becomes permanent. Financial systems run on something more fragile than capital: trust. And once trust is broken, it does not regenerate on election cycles. By threatening foreign financial institutions with arbitrary taxation, the United States sent a message that echoed far beyond Canada. Contracts in America are now political instruments. That message is lethal to long-term capital planning. Even if Trump disappears tomorrow, the precedent remains. Boardrooms in Toronto, London, Frankfurt, and Singapore are already rewriting risk models. U.S. exposure is no longer treated as baseline safe. It is now flagged as policy contingent risk. That designation never goes away. It gets priced in forever. This is how empires lose influence, not through defeat, but through self-inflicted unreliability. And America's competitors are watching closely. China does not need to outcompete the U.S. if the U.S. scares capital away on its own. Russia does not need financial dominance if Western systems fracture from within. Every dollar that leaves the American credit ecosystem strengthens alternative financial centers and weakens Washington's leverage. The North American credit system, once a seamless engine, is now splintering. Canada is building redundancy, Europe is absorbing capital, Asia is welcoming it. And America? It is learning far too late that power based on coercion is not power at all. It is fragility disguised as dominance. When allies stop trusting your rules, they stop playing your game. And when capital stops believing in your system, it quietly builds another one, without you. History is brutally consistent on one point. Power built on cooperation compounds. Power built on coercion collapses. Donald Trump believed financial threats would force compliance. Instead, they exposed something far more dangerous: that the United States is now willing to weaponize its own legal system. And once that line is crossed, capital does not argue, it leaves. Canada did not shout. Canada did not panic. Canada simply chose survival over sentiment. The result is a North American credit system sliding toward fragmentation. Millions of American businesses facing higher borrowing costs or no credit at all, and Wall Street staring into a liquidity crisis of its own making. So here is the question that will define the next decade. If the world's richest neighbor no longer trusts the United States with its money, who still should? Because when trust collapses, no amount of tariffs, threats, or bravado can rebuild it. And the real collapse does not announce itself. It happens quietly, one withdrawn loan at a time. Your move, America.